Good morning, everyone, and thank you very much for joining me. This is the morning market review. It is Thursday and it is the 7th of September. My name is Russell Shaw. I'm a senior market specialist at FXCM. I'd like to just draw your attention to my email address, rshaw@fxcm.com. And of course, if you'd like to correspond, that is the email address to use. I'm going to go ahead and bring up our disclaimers. I'm going to start off with the high risk investment warning. Morning, Howard, Kim and James. Pleasure to have you on the webinar. Welcome. I want to wish everyone a warm welcome. Thank you very much for everyone signing in this morning. I'll just keep this high risk investment warning on a few moments longer. All right, here is our market commentaries disclaimer. Thank you. And our references, market scope and trading view. As we've been doing the last few webinars, we want to check the real rate, because I think that's where the story's at. The top chart is the real rate. This middle chart is the RSI of the real rate, and the bottom chart is the US dollar. And that's sort of where we start, and then we move along that spectrum of cause and effect. And again, just to point out the obvious here, but we have a bullish cross in a real rate. Okay, so real yields moving up, and the underlying momentum strong as can be. Let me just make this that color. And then what is happening is that the US dollar is being pulled up with a real rate. The way that we can measure that is we're just going to throw in a correlation coefficient between the real rate and the US dollar. So go through to indicators and just choose correlation coefficient. And I'm just going to put in the US dollar there. And we've got a very robust 65%. So at the moment, okay, there is a distinct correlation between the real rate and the US dollar. I just want to explore that a little more. Just bear with me. What we'll do here is we'll bring up Microsoft Paint, and I just want to just use some basic economic diagrams just to show you what's going on. You've basically got the demand side of the economy, and you've got what we call the supply side of the economy. And the way that it's represented in economics textbooks is as follows. You get a set of axes, and what we can do is we can put inflation, and we can put GDP growth. Okay, and what tends to happen is you've got a certain level, that the economy can grow at its a certain maximum level. You can't, if it goes past the maximum level, then we're burning hot. Okay, if we below the maximum level, then we've got a gap, right? And then effectively, you've got your demand curve that looks like this. It's downward sloping. I'm going to actually put it as such. Okay, so what we have here is an economy that is really past its potential, and where the two intersect, let's just label these. This would be what we call aggregate demand, and this would be aggregate supply. And what's happening is the Fed is raising interest rates. What that effectively does is it's supposed to bring the demand curve down. And then what happens is your inflation comes down. Okay, I'll just use the red for. So once you've got an increase in interest rates, your aggregate demand shifts. The way that we can perhaps explain that is that, just think about it on a personal basis. As interest rates increase, say on your loans and mortgage and credit card, well, you've got less money to spend, so you demand less, right? And inflation comes down, and the GDP growth comes down sort of towards your let's say equilibrium point. Now, what is the problem at the moment is that we're not seeing any slowdown in the US economy. A slowdown in GDP growth means that unemployment typically should move up, and it should show GDP coming down. That's not what we're seeing. We're seeing relatively robust unemployment, robust employment, a robust labor market, and we're seeing GDP that's increasing. And this is after 11 increases by the Federal Reserve. So now the market is, now we go through to the long-term real yield, and because we're not getting this contractionary effect that the Fed is effectively wanting to do, okay, we're getting this phrase, higher for longer. Higher. So the market's now thinking we're going to have higher rates for longer, so that eventually we do get that contraction in GDP, that we do get the unemployment rate up slightly. So this higher for longer is being reflected in the 10-year real yield. And if we take a look at it on a long-term basis, it's at levels, let's go through to the monthly chart here. I mean, we can go all the way back to 2009, 2008, I beg your pardon. That's kind of where we are now with the real yield. So it's really elevated, that we have it's sort of decade highs, and the dollar seems to be a major beneficiary of that. That's the key driver of the market. And if that's the key driver of the market, we've got to pay attention, because it's seeming to suggest dollar strength. That's what we've been saying for the last few sessions that we've been logging in, is that there's this dollar strength. And when there's dollar strength, it must weigh negatively on the other Forex majors, okay, because they are counterweights to the US dollar. And of course, higher interest rates to me suggests that there is a fragility in the risk markets as well. And that's what we're dealing with. That's what we're dealing with. So if we take a look at market scope, and what we're going to do is we're going to bring up the US dollar, and we'll do an analysis. Now, just remember the fundamental, the underlying fundamental. We've got this real rate moving up. Okay, so what we can do is we go to the US dollar, the monthly chart. Take a look what's happening on the monthly chart here. Now, the monthly chart is significant. Okay, the higher the time frame, the stronger the technicals. Okay, now I think what we're seeing on the monthly chart here is certainly worth taking note. It's important. I just want to see if there's any comments coming through. Just bear with me. Okay, no, we're all good. Okay. We've got effectively on the monthly chart a reference candle over here. And what's happening now, I've got to be very careful here, and we've got to be understanding this is a monthly chart. In other words, it only closes at the end of the month. We're only the 7th of September, so we've got another 3 weeks left of trade before we close out the month. But what you can see is that the reference candle here was confirmed by conditions 2 and 3 for August. And now look at September. September is now almost suggestive of a swing starting, right? And that would make sense because we've got the reference candle here. And we just want to see where it ends. But at the moment, we've got a higher high and a higher low for September. Take a look at the exponential moving averages. The exponential moving averages are starting to diverge away and starting to move in a northeasterly direction. Take a look at the RSI. It's pulling away from 50 on the positive side of 50. And then what I think is interesting is that the dollar is effectively breaking out. Okay. Here is the measure. If we take out this level here, there's a breakout on the US dollar. Well, that puts us in a very interesting paradigm. Then we're looking at dollar strength as a key story in the market. And if that's the key story in the market, as traders, we've got to let that drive our actions. So if we're getting a strong dollar, well, go down to the weekly chart here. We can see we've got a higher trough, higher peak. Go down to the daily chart here. And what we saw yesterday, when you and I met yesterday, we saw we were in zone 1, but we actually saw that we had a bit of a dip. Do you recall that this wasn't, yesterday's candle wasn't blue, it was red. Okay, so we looked down and then there was a kick up here. So there was a kick up in the dollar, and there is now some bullish momentum to the upside. Now, over here, what happened yesterday? What's this arrow here? What happened yesterday? So yesterday we had something called the ISM services PMI. It's a very important data point. It's data that comes from the front line. It's a survey that goes out to managers, and effectively the services is the majority of the US economy. The US is a services economy, and what happens is the production managers are effectively answering in the affirmative, and we got a very strong services PMI yesterday. Well, that's, again, how does that fit in with the Fed's contractionary policy? And as long as we keep getting this good news, well, good news at this stage is probably bad news, because it suggests that the Fed is going to keep their rates higher for longer. And if they keep their rates higher for longer, well, we saw what was happening on that monthly chart. The dollar was starting to break out. Well, if the dollar is starting to show signs of breakout, what's happening with the euro? So we can go down, let's take a look at the euro. Okay, let's take a look at the euro on and you can just see how it's been absolutely smashed since the 15th of July, been absolutely hammered to the downside. Where are we on the zones? We're in zone 3. Yesterday, we saw that there was a bit of a bounce up, and then here is the PMR coming out. Okay, now take a look. Euro looks to be expanding to the downside today, and the stochastic has crossed over to the downside. Okay, if we get angle and separation and we get the stochastic moving to the lower quintile, we likely see lower euro prices ahead. Let's take a look at cable. Okay, let's see. Remember the cause and effect. We looked at real rate, dollar, and now we're looking into the other majors. Go through to cable. All right, zone 3. Okay, it's really got pushed to the downside yesterday. We were looking at the crossovers yesterday. So the crossover started. The stochastic moving towards that lower quintile. It looks as if it's starting to cross down again. One of the big movers that we looked at yesterday was the Aussie. Okay, let's just go through to the Aussie. Beg your pardon, just give me a moment. Here it comes. The Aussie dropped into zone 3. All right, it seems to have held its own. Here is the sell down. Here is the sell down. Well, now it's at central pivot resistance. You can see a selling tail coming in. All we need to do is see if we get a crossover here. So the main sort of story that we're talking about is real rate supporting dollar and really acting as headwinds on the rest of the majors. Another chart, just the last one we'll take a look at this morning, is gold. Gold has been fairly resilient, but it looks as if it might be starting to show signs of cracks. Let's just have a look at the precious metal and see how that's tracking. And it's fallen from zone 1 into zone 2. So that's a relative weakness. It's a step backwards. Take a look at the RSI. RSI has has dipped below 50. So there is some downwards movement, a little bit of blue. So perhaps we get a rally in some weakness. So what we want to see is, do we get the exponential moving averages showing angle and separation to the downside? Do we see the stochastic crossing lower, heading into the lower quintile? So that's the way that we've analyzed it. We've started at the real rate, dollar, and moved on through to some of the majors and to gold. So you can see that there's certainly some headwinds in the market. Very last chart. Let's take a look at DAX. Okay, we'll just bring that up and see how the German bourse is looking to open. It's just gone past the cash open. All right, so in the German 30 dropping, it actually it looks similar to gold, doesn't it? It's dropped from zone 1 into zone 2. It's now threatening to go into zone 3. So weakness in the German index. And you can see here we've signaled a crossover. Here we signaled crossover. Well, you can see that the crossovers are continuing. Now, what's interesting here is we are at S1 support. We'll see if that has any influence. If the stochastic stays at the 20 or below levels, then the S1 level is going to go. Okay, so it's all about now if the stochastic holds in that lower quintile or whether it bounces out. But you can see that The DAX has been under some pressure for the last few days. We're now at a support, this S1 support area, and we want to see if there's going to be some sort of defense here by the bulls. Very fragile for them. That's a very fragile situation. The bulls trying to mount a defense when the momentum is definitively on the bearish side. All right, so that's as far as we go this morning. If there's any questions, please go ahead and type those in. Any questions? All right, nothing coming in. So what we'll do is conclude at this point. I want to wish you guys a great day, great evening ahead. We shall chat tomorrow morning. Thanks very much, everyone.